Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking to our Head of Research, Jasper Lawler, to discuss why the S&P has hit new record highs and whether it's sustainable. We'll look at expectations for the German election, possibilities for the dollar after this week's Fed meeting, the Bank of England decision, as well as Brent crude prices. But first, some earnings releases and economic calendar items this week. Starting with corporate results, it's a slow start on Monday, but then we have French Connection, Adobe and FedEx on Tuesday. On Wednesday, it's B&Q owner Kingfisher, General Mills and beer group Miller Coors, Capita on Thursday, and then we finish the week with Saga and Smiths Group on Friday. Moving on to the economic calendar, we've picked out what we think could be the most market-moving releases. On Monday, the Eurozone Final Consumer Price Index. On Tuesday, the Reserve Bank of Australia meeting minutes and the German ZEW survey. On Wednesday, UK retail sales and the highlight of the week, the Federal Reserve meeting. On Thursday, it'll be the Bank of Japan policy decision, and on Friday, the European Flash Manufacturing and Services Flash PMIs. So Jasper, new record highs in the S&P and the Dow last week. I'm starting to believe this bull market is never going to end.
I tend to agree with you, Kelly. It has been lasting a while. In fact, a little factoid for you is that it is the second longest bull run in the S&P 500 without a 20% correction ever.
Wow.
So yeah, we're getting pretty overextended, so it's understandable that people are starting to wonder when the top is going to happen, but momentum is a strong force, and the momentum is very much to the top side at the moment. But I think you probably can put your finger on a few things why we're still feeling confident about the market. New hopes of a Trump tax plan coming back through. Oil prices have been rising again, that's good for energy stocks. The dollar has been falling, so that's good for US international earnings. Probably explains why the US stocks are outperforming European at the moment. And obviously those geopolitical worries we had, well, they're out the window for now.
Yeah, of course. Now, for one last chance of a political upset this year, the German election happens this Sunday, but actually the DAX looks in pretty good shape.
Yeah, we just hit 2-month highs in the DAX, which is interesting because we were near 2-year highs in the euro, although admittedly it slipped back a little bit recently. But both neither signs of massive concern in the market about this. Merkel is basically riding a wave of just a good economy in Germany, and there's not enough dissent really. And on the flip side, what would that dissent come in the form of? Scholz, he's just not a very strong opponent. He doesn't really offer enough different. To some extent, it's difficult for him because the two main parties in Germany have been sharing power. So who do you go to still have hopes of picking the winning party, but actually choose some opposition? So it's a bit of a kind of dead end in German politics to some extent. I would say the biggest chance of disruption that we still do have, the very minimal chance that Merkel just doesn't get elected, or it's much closer than is currently expected, or if the AfD, that's the kind of nationalist party, if they take enough of the vote, which again is not being predicted right now, but if they do take enough of the vote of the other smaller parties, which Merkel needs to form a coalition, then suddenly maybe they're in a position to impose some of those kind of nationalistic policies on the main agenda. But so chance of those, but at the moment, market not pricing it in. Plus side of that is if it does happen, you get the good volatility, but probably the downside is it's not that likely to happen.
Yeah, right. Okay, thanks. And so the big one this week, as I mentioned earlier, is the Fed meeting. What will you be watching out for there?
Well, the big deal recently with the Fed is that Stanley Fischer is stepping aside. He's still going to be part of this meeting, but going forward, there's a bit of a power vacuum at the Fed. Kind of leaves Janet Yellen on her own to some extent. So it'll be interesting to see if the language starts to change already. Dudley is probably the second in line in terms of the most powerful voice within the Fed when Fischer steps aside, and he noted that it's too soon to predict the timing of the next Fed rate hike. So it doesn't really look like this meeting for a rate hike, probably isn't going to be December either. So rate hikes are off the table, so now it's more about the balance sheet, really. So that's what I think they're trying to do, is they're trying to switch gears towards the balance sheet normalization, they're calling it. Basically, when do they start selling all these bonds they bought? I think if they do get a bit more aggressive on that than is currently expected, maybe even say they're going to start selling the bonds this year, I think that actually could create a bit of nerves, and maybe that would be one reason we could see stocks start to roll over and a bit more interest in the dollar.
Yeah. Okay. And looking back for a moment at the Bank of England decision last week, is the rate hike any closer, do you think?
That was a real surprise, a positive surprise for me, that it does look a lot closer now, potentially even this year, which is crazy. Most people, the consensus opinion was not even in 2019 were they likely to raise rates. And suddenly people are talking about this year, 2017, as a possibility. So funny, really, because it's been about a year, so it's almost a sort of, sorry chaps, sorry about that rate cut, we're back to normal now a year later. Forget about that last year. So, inflation is close to 3%, so that's obviously their main motivation here. Growth is slowing, so that's why the opinions before this meeting were that they're going to hold off, because the thing is, normally, why do you raise rates? You raise rates to cool off an overheating economy. The UK economy is not overheating right now, it's slowing. But obviously we've got inflation, so you have to deal with the higher prices. So I think probably the mindset that people need to adjust to is that we're not really hiking here. The reason to hike here is not to slow an overheating economy, it's just to get interest rates back to a more normal level that doesn't create asset bubbles. Mm-hmm. And so I've been saying that same thing for the last few years. It looks like maybe the Bank of England, because of the higher inflation, are actually starting to get on board with that too.
Yeah, okay. And finally, before we wrap things up, oil is up $10 per barrel in 3 months.
Yeah, I know. It's been quite a rapid rise. Literally since we joked about whether it was a bottom or not in one of these videos, it's just been going up since. And so, I think, I mentioned a few of these things in my snapshot video. I was talking about $55 in Brent. That's still a pretty key level, because a lot of people have been talking about oil just staying within sort of 45 to 55 range. You can kind of switch that between Brent and WTI. WTI is approaching $50 per barrel, so that's the big psychological level there that we still need to break through. But to my mind, it looks like things are shifting. We've had data from OPEC, we've had data from the IEA, all suggesting that supply is coming back. And obviously the supply glut in the market was the big fear factor. The risk is that this is just temporary, because the storms in the US have disrupted a few things. But I think all put together, we had that big test of 45, the market didn't drop further. To my mind, I'm a little bit more bullish now, I think, on oil than some. I actually think we could break out here, and we could be in the midst of a decent run higher.
Right, okay. Thank you very much, Jasper, and thank you very much for watching. Don't forget to follow us on our LCG page on YouTube and Facebook, just to get these videos as they're released.